Okay, time now to welcome on board Ashish Gupta, the Chief Investment Officer at Axis Mutual Fund, joining us. Ashish, hi, thank you so much for making time and speaking with us. What's your own call on the market right now? Do you see that there are more legs to the rally, or a bit of a consolidation, a bit of a pause, and then we'll head to perhaps 20,000?
Sure. No, I think we have seen a very strong rally over the last 3 months. I think we have got support both from the rate side as well as the fact that the initial fears of a US recession have receded. Having said that, I think the global macro is still trending weaker. There is a need for caution, particularly going into the second half of the year. So I think one has to be very selective in this market. I think valuations have gone up as well. The market is now trading over 20 times earnings. It's a level about one standard deviation higher than the average. So we need to be selective in these markets.
Right. Okay. Ashish, what are you making of the strength in IT? Surprised by that? Or do you think it's a typical bull market phenomena where the street is like, you know what, let's give them time. Maybe a quarter or two down the line, they will improve and maybe the worst is behind us.
Sure. So I think a couple of factors really helping IT, right? One is the positioning. I think compared to the rest of the market, over the past 2 months, IT was a sector that had been sold down and the valuation gap with the rest of the market had opened up. Secondly, we had seen a sustained rally in the global tech companies. The third, as I mentioned earlier, you have had the fears of US recession receding. I think one other important fundamental change that has happened in the IT sector over the past 4 years has been the cash payout that these companies have started, both in form of dividend and buybacks. And if we see the ROEs the IT companies are delivering today, they are in the range of 25 to 30%, which compared to the rest of the market is attractive. I think this is what is really supporting the fact that despite relatively muted demand outlook for the current year, there has been a rally in the stock from the oversold levels.
So Ashish, is IT the undervalued sector to bet on from here?
We are actually not really overweight the sector. We believe that we have to be focused on pockets that will deliver growth. For us, sectors like financials, autos, consumer, these are sectors where we are much more positive on the growth outlook. In sectors like autos and consumer, we are actually also expecting a dose of margin expansion to support earnings because these two sectors had challenges in terms of input price pressures, and those are receding now.
Okay, hi there, Ashish. Good morning. Wanted to also understand what the outlook is when it comes to banks. Is that going to continue to remain a compounding story, especially when it comes to some of the frontline large caps?
Yes, and I think we continue to see really cyclically the sector has come out of a major credit cycle of the past decade in a very strong shape. We have seen both private and public sector banks really recovering, and now loan growth there has picked up as well. In fact, lately, even the NBFC loan growth trends have picked up. So if you compare 12 months ago, NBFCs were lagging in terms of growth vis-a-vis banks, but that is no longer the case. And NBFCs have really consolidated their balance sheet, both in terms of liquidity, funding, as well as asset quality. So there were a couple of segments for NBFCs like real estate loans and microfinance that were challenging, and they have cleaned that up as well. So financials is a big overweight sector and a preferred sector for us across both banks and NBFCs.
overweight on financials, both the banking names as well as the NBFCs. But Ashish, you briefly mentioned that you're quite positive about the Indian consumption story and autos, etc. Specifically within autos itself, what are the areas or themes that you're watching out for? Is it the entire EV play? Is it the two-wheeler bouncing back?
So, in fact, I'll actually add a third dimension is also the auto component space. We are seeing increasingly many Indian companies do well on the export front as well. So one trend we are seeing is, or we are looking to see is pick up in the sector growth rates. On back of some demand recovery, given that demand has been under pressure for the past couple of years, and we believe lower income and rural consumption should be bottoming out. But additionally, I think there are several component companies where exports are another meaningful driver. So those are the kind of two parameters that we believe is going to really drive the sector.
Ashish, what's the view on pharma? Are you part of the group which is saying that it's oversold and the opportunities are emerging, or would you wait for that confirmation to happen and only then dabble?
So in pharma, our focus really is more on companies that have a larger domestic footprint. We believe the challenges in the international generic market are here to stay. It's very difficult to, with confidence, predict multi-year consistent growth rates for companies. And we find that people exposed to the domestic market have more consistent growth rates, and we feel more comfortable there.
Okay, fair enough. Just wanted to get in your perspective as well as to where you believe, as a sector is the most overrated space as of now, Ashish.
So I think rather than sector, I think we have to look at specific stocks. We were doing one analysis in our team that really, while the market average PE is 20, but if you look now, nearly a third of the market is trading at a PE of almost 50 times. So I'm talking about companies over $1 billion market cap. So about a third of companies over $1 billion market cap are now trading at a PE of over 50 times. So there are really in terms of valuations, pockets which are stretched. So it's very important that people select stocks where growth certainty is high.
Watching for that growth certainty is certainly important, but Ashish, you're quite, you're getting a bit selective into the market, but what are the key monitorables or risks that you see for the Indian markets? Because of late, the flows are back, there is a lot of, positive momentum around domestic manufacturing, etc. as well. But what are those risk areas? Because monsoon now too has panned out. It's been very, very sporadic and erratic, but nonetheless.
Yes. I think this is what is clearly reflecting in the market multiples, that there are no evident risk. The Indian macro is very, very stable. I think as has now been called that twin balance sheet advantage, that corporate balance sheets are unlevered, bank balance sheets are very clean. Even on the fiscal side, we are seeing fair bit of consolidation. Government capex has already started, and private capex is looking like it will follow. So on that count, everything looks good. I think we still need to actually watch the external front, both from a geopolitical situation. What's happening in Russia and Ukraine is still not over, and also in terms of what's going to happen to global demand, because India, both on the goods and services side, is now fairly exposed to global demand, and that's contributing to a large part of GDP. So services exports, as you know, is about 10% of GDP. And while fears of US recession have receded, I don't believe that it's still entirely ruled out. Europe and China continue to show weaker and weaker data. So I think that is something that will be really the big drag on India's growth is the global outlook.
Appreciate your time. Thank you so much for joining in and sharing with us your outlook on the markets as well as your view on individual sectors. Let's just check in on